So, you sent over some info on FedEx the other day,
Uh,
ticker symbol FDX.
right.
You were really hoping to kind of get a better sense of where they stand right now
Yeah.
and maybe where they're headed.
Absolutely.
And that's exactly what we're going to be focusing on in this deep dive today.
Great.
We've got their latest earnings report.
Okay.
This is the one that came out March 20th, 2025.
Right.
It's for Q3 of their fiscal year 2025.
Okay.
We've also got some notes on what analysts are saying about them,
Got it.
and we've pulled some important financial data as well.
Right.
So our goal here is to cut through all the noise and try to give you a clear and simple picture
Yeah.
of how FedEx has been performing recently, what their biggest challenges are, and what their potential opportunities might be going forward.
Makes sense.
So let's jump right in.
Okay.
The thing that really jumps out at me when I look at this
Yeah.
is,
What's that?
well, it's kind of a paradox.
Oh, okay.
On the one hand, their revenue is up this year.
Oh, that's good.
Yeah, it's their first year-over-year revenue growth that we've seen in a while.
Wow.
So that's definitely a good sign.
Yeah.
And it's not just a tiny increase either.
Oh, really?
No, it's up by 2%.
Huh. Okay.
But even more impressive,
Yeah.
their adjusted operating income is up by 12%.
Wow, that's huge.
So even though they're dealing with some economic headwinds out there,
Right.
they're actually finding ways to not only grow their revenue,
Mm-hmm.
but to increase their profitability even more.
So where is that 12% jump in operating income coming from?
Well, the main driver seems to be their
Yeah.
D-Drive cost-saving program.
Oh, right. I've heard about that.
Yeah, and it's really working.
Like, how much are they saving?
Well, just in this last quarter alone,
Yeah.
Drive generated $600 million in savings,
Seriously?
which puts them on track to save more than $2.2 billion annually.
Wow. So they're really focused on becoming more efficient.
Right. It seems to be one of their top priorities.
And it's clearly paying off.
Yeah. I mean, think about it. In this kind of economic environment.
Right, where everybody's struggling with rising costs and everything.
Exactly.
They're actually increasing their profits.
It's pretty remarkable.
So what about their Federal Express segment?
Oh, yeah, that's another bright spot.
Oh, so.
Their adjusted operating income for Federal Express is up by 17%.
Nice. So their core delivery service is doing really well.
Yeah, and it shows that their strategy of focusing on efficiency is working there too.
That makes sense.
But here's the thing that's kind of throwing me off.
What's that?
Well, they lowered their earnings outlook for the rest of the fiscal year.
Oh, really?
Yeah, it doesn't really make sense to me.
Why not?
I mean, if things are going so well.
Right, they're growing revenue, they're increasing profitability.
Exactly. Why would they become more cautious about their outlook?
That's the big question.
It seems like they're sending mixed signals.
So what exactly did they say about their outlook?
Well, they lowered their adjusted EPS range for FY25 to $18 to 18.60.
I see.
It used to be $19 to $20.
So why the change?
They're pointing to a few challenges.
Like what?
Well, for starters, the global industrial economy is still pretty weak,
Right. That's been a problem for a while.
and it's really hurting their business-to-business and priority shipping services.
Because those are the services that are most sensitive to economic conditions.
Exactly.
So it's not surprising that they're seeing some weakness there.
And on top of that,
Yeah.
they're also dealing with higher inflationary pressure than they expected.
Oh, so their costs are going up more than they thought.
Exactly. And that's putting a squeeze on their margins.
That makes sense.
And then there's the uncertainty around global trade policies.
Like what?
Well, all those low-value e-commerce packages that are crossing borders.
Oh, yeah, the de minimis shipments.
Exactly.
Right. Those have been in the news a lot lately.
Well, there are a lot of questions about how those shipments are going to be regulated in the future.
So that's creating some uncertainty for FedEx.
Definitely, it makes it harder for them to plan and to forecast their earnings.
So is there anything else that contributed to their lowered guidance?
Well, yeah, there's one more thing.
Okay, what's that?
They lost a big contract with the USPS.
Oh, wow, that's a big deal.
Yeah, it cost them $180 million in the last quarter alone.
Ouch. So that's a significant hit to their revenue.
Definitely, it just shows how important it is for them to maintain those key customer relationships.
Absolutely. I mean, losing a big customer like that can really hurt.
So to sum it up,
Okay.
we've got strong cost management from FedEx.
Right.
They're growing their revenue,
Uh-huh.
but they're also facing some real pressure from the broader economy.
Yeah.
And they lost a major contract.
Okay, so let's dig a little deeper into this Drive Ice program.
Sure.
Is it really the game changer that it seems to be?
Well, I think it's definitely a major factor in their success so far.
What makes you say that?
Well, just look at the numbers.
Okay.
$600 million in savings in just one quarter.
Right. That's incredible.
And they're on track to save over $2.2 billion annually.
Wow, that's a lot of money.
Yeah, and it shows that they're really serious about becoming as efficient as possible,
It's a good sign.
especially when you consider that they're doing this in a tough economic environment.
Yeah, where everyone else is struggling with rising costs.
So I think it's safe to say that D-Drive is a big part of the reason why they've been able to maintain their profitability.
So it sounds like they're not just cutting costs for the sake of cutting costs.
Right. They're actually using this program to make their entire operation more efficient.
And is that where their Network 2.0 initiative comes in?
Exactly.
So can you tell me more about that?
Sure, it's all about optimizing their network
Okay.
to make it even leaner and more efficient.
So what exactly are they doing?
Well, they're consolidating facilities.
Okay.
They're optimizing their routes.
Uh-huh.
And they're implementing new technology.
Got it.
And their goal is to have about 12% of their daily global volume flowing through these optimized facilities by the end of FY25.
That's ambitious.
Yeah, but they're already making good progress.
So how much do they think they can save with this initiative?
Well, they're hoping to reduce their line haul and sort expenses,
What they call B&D costs.
right, by 10%.
Wow, that would be a significant improvement.
And the best part is that they're doing all this without compromising service quality.
So they're finding ways to do more with less.
Exactly. It's all about making their logistics machine run as smoothly and efficiently as possible.
So you said earlier that their tricolor operating model is also helping them improve efficiency,
Yeah.
and that this model is mainly focused on their air network.
Mm-hmm.
So what exactly does it involve?
Well, it's a system that helps them maximize the use of their aircraft
Okay.
by increasing payloads and density.
So they're basically making sure that every flight is carrying as much cargo as possible.
Right.
And how much of an impact is this having?
Well, so far they've seen a 9% increase in payloads
Wow, that's great.
and a 5% increase in density.
So it sounds like it's really working.
Well, it is, and it's another example of how they're finding ways to get more out of their existing assets,
Which is always a good thing.
especially in this kind of economic environment.
Now, we've talked a lot about their cost-cutting initiatives.
Yeah.
But are there any new revenue-generating initiatives that are worth mentioning?
Yeah, there are a few things.
Okay, like what?
Well, for one, they've expanded their Sunday residential delivery service,
Oh, interesting.
and they've made some enhancements to their healthcare logistics offerings.
Okay.
And those two initiatives alone
Yeah.
are expected to generate an additional $400 million in annualized revenue.
Really?
Yeah, and that's just within the next 90 days.
Wow, so they're definitely seeing some positive momentum on the revenue side.
They are.
And what about the planned spin-off of FedEx Freight?
Oh, yeah, that's another big development.
How so?
Well, they believe that by separating FedEx Freight from the rest of the company,
Uh-huh.
both entities will be able to operate more efficiently and focus on their core strengths.
So it's kind of a win-win situation.
Exactly.
And didn't they also complete a debt exchange offer recently?
Yeah, they did.
Remind me how much that was for.
It was for $16 billion.
Wow, that's a lot of money.
It is,
Yeah.
but it's actually a good move for them.
How so?
Well, it gives them more financial flexibility.
In what way?
Well, it could allow them to lower their interest payments
Okay.
or extend their repayment timelines.
So it gives them more breathing room.
Right.
Now, earlier you mentioned that the weak industrial economy is one of the biggest risks facing FedEx.
Yeah.
So how exactly is that impacting them?
Well, it's putting a lot of pressure on the margins at FedEx Freight
I see.
because, the industrial sector is a big part of their business.
Right.
And when that sector is weak,
Yeah.
it means less demand for their services.
And lower prices.
Exactly.
So it's a double whammy for them.
And they've said that they expect this weakness to continue for a while.
Oh, really?
Yeah, at least through the rest of this fiscal year.
Wow.
They're hoping to see some improvement in FY26.
But for now, it's still a major headwind.
Definitely.
Now, you also mentioned that rising inflationary pressures are a concern, and you even called them a new and significant challenge. So can you elaborate on that a bit?
Sure. Well, even though their D-Drive program is helping them offset some of the cost increases, they're still facing a lot of pressure from rising prices for things like labor and fuel.
Right. Those are major expenses for a company like FedEx.
And the problem is that they don't really know how long these inflationary pressures are going to last.
So it's hard for them to plan for the future.
Exactly. And it makes it even more important for them to be as efficient as possible.
Absolutely. I mean, if they can't control their costs,
Yeah.
they're going to be in trouble.
So are there any other potential risks that we should be aware of?
Well, the global economy is always a wild card. And there's always the possibility of a recession,
Yeah.
which would obviously be bad news for FedEx. Then there are the security concerns that have been in the news lately, like package theft and data breaches. Those are things that could damage their reputation and increase their costs.
So what are the analysts saying about FedEx?
Well, as of the latest report,
Yeah.
the stock was trading around 230.33,
Okay.
but the report itself suggests a fair value of 288.41.
So they think it's undervalued,
Exactly. And they're maintaining a buy rating.
meaning they think the stock is going to go up.
Right.
What about other analysts?
Well, there's a pretty wide range of opinions out there.
Like what?
Well, Deutsche Bank initiated coverage with a buy rating and a 337 price target in March.
Okay.
Bernstein raised their price target to 320 in December.
Uh-huh.
And Citigroup also has a buy rating with a 301 target from October.
So those are all pretty bullish.
They are, but then you've got some more cautious views.
Oh, yeah, like who?
Well, Loop Capital lowered their target to 288 in September. Okay.
And Bank of America Securities lowered theirs to 308 around the same time.
Mm-hmm.
And HSBC actually downgraded the stock to hold with a 300 target in September.
Oh, wow.
And then there are others like Stephens and Goldman Sachs who had higher targets earlier in September.
So, real mix.
Yeah, it seems like the analysts are still trying to figure out what to make of FedEx.
And Raymond James lowered their target to 310 in September.
So is there any sort of consensus among the analysts?
Well, if we take the average of all their price targets over the last 6 months,
Okay.
it comes out to about 314.20. So that suggests that overall,
Yeah.
the analysts are still pretty optimistic about the stock.
So despite the challenges, they think FedEx is a good investment.
That seems to be the general consensus.
So let's move on to their financial health and how they're returning value to shareholders.
Okay.
One thing that really stands out to me
Yeah.
is their share repurchase program.
Oh, yeah, they've been buying back a lot of their own stock.
Right. They've spent $2.5 billion on share repurchases so far this year. And that's a sign of confidence.
Exactly. It shows that they believe their stock is undervalued.
And it's also a way to return value to shareholders.
Right, because when they buy back their own stock,
Uh-huh.
it reduces the number of shares outstanding,
Yeah.
which increases the earnings per share.
Right. And that can boost the stock price.
Exactly.
Now, what about their capital expenditures?
Well, they've actually reduced their planned capital spending for this fiscal year,
Yeah.
$4.9 billion.
So they're being more disciplined with their investments.
Right. They're not just spending money for the sake of spending money.
And that's a good thing,
Yeah, especially in this kind of environment.
where it's important to be careful with your cash.
Now, what about dividends?
Well, they announced a quarterly dividend of 1.38 per share
When was that?
back on February 14th,
Okay.
payable on April 1st.
And that gives shareholders a steady stream of income.
It does.
So for anyone who's looking for a reliable dividend payer,
Yeah.
FedEx is definitely worth considering.
Okay, so just to wrap up, FedEx is a company that's facing a lot of challenges.
Right, like the weak global economy, rising inflation, and increased competition.
But they're also taking steps to address those challenges.
Like what?
Well, they're aggressively cutting costs through their D-Drive program.
Uh-huh.
They're optimizing their network.
Right.
And they're finding new ways to grow their revenue.
Like expanding their Sunday delivery service and their healthcare logistics offerings.
Exactly. And they're also returning value to shareholders through share repurchases and dividends.
So is it a good investment?
Well, that's a tough question.
I know.
There are definitely some risks to consider,
Like the ones we've talked about.
but there are also some potential rewards.
So it really depends on your individual investment goals and risk tolerance.
Right. But if you're looking for a company that's well managed and positioned for long-term growth,
Yeah.
FedEx is definitely worth a closer look.
So what's the single most important factor that's going to determine FedEx's stock performance going forward?
Well, that's the million-dollar question, isn't it?
It is.
I think it's going to come down to how well they're able to manage these challenges.
Right, like the global economy.
Exactly. And inflation.
And competition.
If they can continue to execute on their cost-cutting plans
Yeah.
and find new ways to grow their revenue,
Mm-hmm.
then I think they'll be in good shape.
But if they stumble,
Yeah.
the stock could suffer.
So what do you think?
I think it's definitely a company to watch.
Well, if you found this deep dive into FedEx insightful and want more deep dives like this on other companies,
Definitely.
be sure to subscribe to our channel
And don't forget to hit that bell icon.
so you'll be notified whenever we release new discussions packed with knowledge.
Thanks for joining us.
And we'll see you in the next one.